This webinar in particular is really special as today we have Prodipta Ghosh, Vice President QuantInsti, with us, who leads the FinTech product and platforms development at QuantInsti. He is a seasoned quant, and prior to joining QuantInsti, he spent more than a decade in the banking industry in various roles across trading and structuring desks for Deutsche Bank in Mumbai and London, and as a corporate banker with Standard Chartered Bank. Before that, Prodipta worked as a scientist in India's Defense R&D organization, DRDO. He is a graduate with a BA in Mechanical Engineering from University and a postgraduate degree in Management from IIM Lucknow. Without further ado, let's get started with the webinar. So, Prodipta, thank you so much for taking out time and agreeing to do this interview. And I would just like to go straight away to the questions. What do you think are the best stocks to buy in this particular scenario? And if you could just throw a little light on that.
Uh, Thanks, Kevin, for the very, very flattering introduction. Now, to answer the questions, we often find this kind of questions in many forums that we attend, that what are the base stocks to buy, what are the infallible signals for trading, and also what works all the time. The truth is, nothing works all the time. If you look at it, the question is what we are missing here in all these kind of questions. We are missing three major points. The first one is uncertainties. When you are talking about investing or trading in financial markets, it is always uncertain. The base stock today is based on our knowledge till date, and nobody knows that what will be best going forward. We need a perfect model of the world to be absolutely sure that this is the best stock. The second point is the changing market, the time dimension. So whatever is best today is not necessarily what will remain best tomorrow, right? So even if our model for the world is perfect today, it's ever changing. And unlike a physical process, markets is a confluence of humans. And there are all sorts of feedback and feed forward mechanisms into that. And it's very, very difficult to model. And finally, the most crucial part we're missing is the context. So base stocks are a fantastic strategy, which can be based for you, not necessarily is based for the person sitting next to you. Because we all have different goals, we have all different wealth levels, we have all different risk appetite that we can afford to lose and not lose our good night's sleep. So even with the perfect vision and the perfect model of the world, it will not be possible to come up with answers for this kind of questions if everyone is different context. So even with a full 2020 future vision, these questions are almost impossible to answer.
Okay. So as per I could understand, so there is no perfect strategy for anyone in this world. But what kind of trading signal do you think always work? I mean, there has to be something that works for someone, or is it not true?
Okay, so let's take an example. For example, suppose you were a trader in, say, some market, let's say in the Indian market, and around this time last year, you thought of coming up with a few strategies and going into the market for trading. So if you do that, for example, I have a couple of 4 different strategies that we have backtested back in July 2018, right? So this 4 different charts you see, It is backtested in one of our platforms. In case you guys are not aware of, it's called Quant Blueshift. It's a research platform with free minute level data. So you can check it out. So the first strategy is a very naive strategy of using a Bollinger Band. Basically, if it is closer to the upper band, you sell. If it's closer to the lower band, you buy, and something close to that. The second one is a simple moving average crossover strategy, some short moving average crossing over a longer one. The third one is based on some sort of candlestick pattern. The particular pattern that we have used here is called doji. Don't worry if you do not know about what is a doji pattern is. So that's not the important point here. And finally, the last one is it doesn't really look good, does it? So it's based on RSI, the relative strength index. Again, if it is greater than 70, you sell. If it's if it's lower than 30, you buy. A very, very standard strategy. Is nothing great here, but some of them work, some of them doesn't. Now, suppose last year around this time, you did all this research, this backtesting, and then you found this past performance, the results of the backtest. So which one you will pick? So I'm sure that most of the guys that are present in today's webinar have some pretty decent idea about how to choose a strategy. So for example, if you look at the top lines of each of these pictures, you will see that each one of them has some sort of information about the risk and returns. So for example, the first one has a 14.77% of returns for the duration of the backtest, which is beginning around May of 2017 till July of 2018. And it also has a Sharpe. So typically we pick a strategy based on its Sharpe ratios. So higher the Sharpe ratios, better the strategy, at least theoretically, which is Sharpe ratio is just the ratio of analyzed return versus annualized volatility of the strategy. So based on that, if you have to pick one strategy, which one you'll pick? The answer is quite clear, right? It's the third one, which happens to be the doji one. And if you are the sort of persons who try to find the best strategy and invest in them, so you'd have invested in the third strategy, and this is what would have happened starting from July 2018 till date. So just after you invested in the base strategy, you had a huge drawdown, and that drawdown is around 10%, around closer to 11%, in fact. And that's a quite nasty drawdown for a proprietary trader, or even for a large fund. And if you see that in our backtest before, the returns were around 20%, 19.85 to be precise, for the strategy we picked. And then even after investing for one whole extra year, the returns scaled to a certain level is not much different. So we are almost flat for the duration of our investment. Now, if you have been a bit more careful, and if you had a trust issue with all your strategies and invested your total investor capital equally among all the four, this is what would have happened. You see that this nicely avoid that drawdown that you've seen in the other strategy. So this is the reason that why the portfolio is so important. So we haven't done much. So we just picked up some equally allocated portfolio from all the strategies that we researched, and we avoided almost a ruinous drawdown. So the reason is that nothing is the best working strategy or the best stock, which is today, we do not know, and going forward, it definitely will not remain best or the infallible. So that's why we go for portfolio way of investing. So no matter whether you're investing in stocks, individual stocks, or in alpha generating strategies like this ones we saw, or you're even allocating between different asset classes. So for example, you're buying houses versus investing in real estate REITs or even bonds. So portfolio is a very, very important part of your investment process.
Okay. So as you mentioned, Pradipta, that everyone here must have a decent idea what portfolio management or what strategy making is. Let's say that we do not. So if you could just explain what portfolio management is basically, and as far as I could understand, is it just investing in more than one or more assets, or what is it? If you could just explain that.
Sure. So at the risk of being a bit technical, um, portfolio is, so you have single strategies or single stocks. You can think of them as a single stream of returns. So whether it's a strategy or whether it's just a buy and hold of a single stock, whichever way, the portfolio management, on the other hand, is a meta strategy. That is a strategy for strategies, right? And that meta strategy is concerned about um, risks, the uncertainties that we talked about, and context, the context we talked about in the first slide, if you remember, and the passage of time, right? So if we think about in terms of a bit of maths, um, a strategy, the value of a strategy is effectively uh, the positions that you have taken on underlying, and then the underlying return, that is for one period, then it goes on multiplying and accumulating for periods over periods. So the value of the strategy becomes this. If you're not very familiar with mathematical notations, which is absolutely fine, it's not important. What is important is to get the idea. So the idea is that the value of a strategy is driven by the underlying returns multiplied by your positions in the underlying. So here, the Greek symbol phi is the positions that you have taken. So that is t minus 1, that is the day before or the time period before you're computing the returns of the underlying. And S is the returns of the underlying for period t. On the same line, the portfolio value is very similar. So instead of ST, the underlying strategies, we are replacing it with RT, which is the strategy returns itself instead of the underlying. So for example, if your underlying is a stock and your strategy is long only, so phi will always remain 1, and S will be just simply the returns of the stock, and then RT will be the product of 2, which is again just the return of the stock. And then we are multiplying by, weighing it by the allocation to it. So that's where the factor W comes in. So for example, if you have a total investable capital of say $100,000 and your underlying universe is around 10 stocks, so, and you're investing equally in each one of them, so W for each will remain as 0.1 or 10%. So this is the portfolio value. So basically, the strategy value is a stream of underlying stream of returns. Portfolio value is the weighted underlying stream of returns. So portfolio management is about solving this mathematical problem that you see here, which is we define a function u, which is a function of the portfolio value p, and for a particular definition of u, we try to find the weights w that satisfy a maximization condition. So we want to find those allocations, those weights W, in such a manner so that it maximizes U, which is a function of P, which is a portfolio value. Now, depending on what U is and how we define the function and how we do the optimization, we have a wide range of possibilities. So for example, how we optimize, how we define U, that defines many ways of optimization, like we'll see later: mean variance optimization, Kelly optimization, risk parity optimization. how we optimize it itself, the optimization, the solver, that defines whether it's a static optimization, that is, you just optimize for this period to the next period, or you want to optimize it in a dynamic manner, so almost continuously you're rebalancing your portfolio. Or what are the types of constraints that you specify in this optimization problem? So for example, if you specify that your W only varies between 0 to 1, so that means you're trying to build a long only portfolio, you cannot go short, or you can even go for a long short or leveraged portfolio. And how we choose the set of underlying return stream, that determines whether how you're building the portfolios, the pillars, whether it is a set of alpha strategies, like the examples that we just saw, or it is factor portfolio. If you don't know about what is factor, don't worry, we'll have a closer look at it. And also the value portfolio, or just a bunch of stocks. So whichever way. So this is more or less what portfolio management is in a nutshell. You are trying to define a meta strategy that satisfy a maximization condition so that your portfolio value is maximized, or rather a function of your portfolio value is maximized. So this is if you have to define what is portfolio management, I'd say this is very close to a definition.
Well, that clears it up. But so, for example, say we have n different strategies or say stocks. So, can we just invest equally to in everything to build our portfolio?
Okay, so actually, you'll be surprised with the answer, I think. Actually, this is a very good question. Many people think that probably the answer will be no, but under certain circumstances, the answer is probably yes. So let's see. Um, so as you see that this is what building portfolio is, solving this mathematical equation. Um, so equal portfolio makes sense in certain scenarios. So one scenario is very trivial, of course. You might have guessed that you have all the things equal. So you have exactly 4 different strategies. So it's a trivial case that, of course, you can go for equal allocation. It doesn't make any difference. The other one is that if you are familiar with calculus, you can figure out that when we are talking about solving this equation and we get equal allocation for all the strategies, it smells very much like we are trying to maximize the products of the weights. So although u is a function of p, it doesn't have to have p in this. So in this case, the u degenerates into a product of the weights. So this is one way of looking at it. Now, economically, there is not much explanation that why would someone do this. But the third point is what average portfolios really is. So if you have some sort of data science background, I'm sure that you guys are familiar with what you call regularization. So for example, if you're doing a linear regression, or even if you're doing even if you're training a network, you'll add some regularization. So in network, the common regularization is usually the dropout. But in linear regression, one very common regularization method is what we called L2 regularization. Also, this kind of regression is called ridge regression. So that is basically trying to um, give a penalty based on the square of some errors. And here, what we can think of when you say that we are going to invest equally in all the asset classes, so here we can think of this is an optimization problem where we're trying to maximize the portfolio value, the U, and also we are trying to putting a penalty on this with a very, very high penalty value on the square of the error. And we are so much uncertain about our models, our underlying models, that we put a very high penalty value, and then we end up with a equal allocation for all this, because of course you know that if you want to minimize x squared plus y squared plus z squared with the constraint that x plus y plus z equal to 1, you'll end up with a solution of x equal to y equal to z. So this is what happens when you go for average allocation. So we'll see later for what are the cases for different types of allocations when one should do what. So the case where you have a very high uncertainty about the model of your world, this is a case where we should go for equal allocation portfolio for whatever is your investment universe or strategies. But empirically, of course, it does good. Actually, it's not very bad. But if you have a good model, we can do better than random.
Okay. So as you said, there's a fair chance of having an equal weighted portfolio do well. So are there any particular approaches to better an equally weighted scheme?
Let's see. So if you have a better model of your world, uh, uh, better model of the market, to be more precise, you can do better than average portfolio. So let's be reasonable and let's assume that we can predict the expected returns of our strategies, and we can measure the risks of our strategies or the assets, right? So now it sounds like a very simple assumption, so it's not that straightforward. We'll see later that measuring the risk is a bit more easier, but expected return, estimating that is a bit tricky. But let's assume for the timing that is possible. And we also assume that we prefer a higher returns for a given amount of risk, which sounds like a no-brainer, but actually it took us for a long time to uh, formalize this statement, a really long time. And alternatively, for a given return, we prefer among different portfolios with the same return, we prefer the one with the lowest amount of risk. So if you have these two sets of assumptions, then this sets up for the famous mean variance optimization, or also known as modern portfolio theory. And we can see that somewhat this is something closer to what we called quadratic utility.
So, as I could understand returns, but what exactly do we mean by risk, and what is this utility function? If you could just explain that.
Okay, so I think risk most of us already have some idea, but utility may be new for most of us. So let's take an example. Let's take a look at this particular game. In case you guys are not aware of it, this is also known as St. Petersburg paradox. So you pay a certain amount of dollars, let's say dollar X, to play a betting game against the house, the casino. The game starts with $1 in the pot that's put by the house. So at each turn, the dealer tosses a coin. If it tails, then you get whatever is in the pot, and if it's heads, then we move on to toss again, doubling the amount in the pot. So, for example, you paid X. If X can be 5 or 10 or 1 or whatever, that is the question we need to estimate. And in the first turn, you get a tail, so you get $1. Game over. On the first turn, it's a head, so you go to so the pot becomes $2. Again, on the second turn, we get a head, the pots become 4, and so on. So it doubles very fast. But as soon as we get a tail, the first tail, the game is over. You get whatever in the pot. The question is, how much one should pay to play this fair game? Now, most of us who are familiar with some sort of probability theory or a bit of maths or even, I'd say, common sense, they would say that under different scenarios, whatever is the average expected outcome of this game, that is the amount that we should pay. So for example, if we see that the average expected value of this game is say $10, we should pay $10. Now there's a problem with this. The problem is apparent in this graph. So what I've done is that I've ran some simulation of this game and ran different simulations and computed what is the expected outcome, and then I arranged them in the increasing order. So you see that it's a very interesting curve. It's an exponential curve, and being an exponential curve, it is very clear that in this case we do not have a average value. If it had an average value, the curve would have been something like closing distribution, or it's fluctuating about a certain mean level or something, where it's an exponential curve. So there is no average value here. So that's why we talk about risk and utilities, and that's how we come about to the conclusion that how much to pay. Just for your if you're curious, so this particular problem can be solved using certain utility function. Again, we are going back to the utility function, um, which is a log utility. Now, this is what, to be more mathematically precise, so this is what a utility function or utility in general you can say. So it's basically a mathematical function of our wealth, our current wealth. Given our current wealth, utility function tells us that $1 extra, how much it is worth. It's kind of a marginal utility measurement for your, in terms of with respect to of your wealth, very, very loosely. Whereas risks is a measure of uncertainties. Now, in many different stream of work, we define uncertainty in many different terms. For specific to finance, we typically talk about risks as something what you call the deviation risk measures. In particular, the standard deviation. Standard deviation is, I'm sure that most of you are already aware of. Standard deviation is basically the square root of the second moment of the distribution. And these two things, they are very, very intricately related. And the relation is what we called risk premium. So risk premium is something that tells us that given two scenarios where you get a certain payout in one option, and in the second option, you have some risky payout. For example, in some cases you lose and in some cases you win, but on an average, you get the same payout. The risk premium tells that the first assumptions that he made before, that people avoid risk. So that assumption tells us that people will prefer the first option, where it is a certain payout. And the risk premium measures that how much less they're ready to take, how much less payout they're ready to take to go for the first option. So the difference between your the expected payout of the second game and the amount that one will settle for with the first option, certain payment, that difference is called the risk premium. We'll see some formal definition, but this is in a nutshell is what risk premium is. So for example, if the most investors in the economy are indifferent between a 3% per annum rate for a certain returns like a bank deposit or a treasury bill, or compared to an expected 8% return from a broad equity market where it can go up to say 16%, it can go negative as well. So that's a risk return. So if people are indifferent between these two choices, so that means that the risk premium in the market with respect to that particular investment, that is equity, is 8 minus 3, that is 5%. So this is what you understand by risk premium. So So
Okay, so how this utility and risk leads us to a good portfolio, if you could just answer that for our audience.
mm, if you continue with the concept of risk premium, so what we define as a risk aversion is effectively uh, the fact that we'll prefer certain investment over a fluctuating investment. So for example, in this expression, that small e is a Greek letter called epsilon. It's a zero mean fluctuating return. So the utility of this, given our current wealth W, the utility of W plus E, this zero mean fluctuating return, is always less than the W itself. That is, we are better without that zero mean fluctuating return. And this fact is called risk aversion. For example, if it is equal, then we say it is risk neutral. And if it is greater, then we say it's um, risk affine. So those are very, very non-standard cases. But risk aversion is a common assumptions that we work on. And the risk premium then boils down to a value of this Greek letter pi, such that W plus that epsilon, the utility of that, is equal to W minus pi. So that is exactly what you said before. That is the amount that we are ready to pay to accept that zero mean noise trading, right? Uh, Now, of course, it becomes a very, very, very complicated expression, and it depends on many things. It depends on W. It depends on the shape, the distribution of E itself, and many other parameters. But if E is small, the epsilon is small, then it becomes by some mathematical tricks called Taylor expansion, it becomes a function of the variance of epsilon. So this is how we see that for certain cases, this simple, this very complicated expression boils down to just a function of variance, and this brings us closer to a way of building our portfolio. If you assume a very special case, so for example, if I assume a form of our utility in this form, don't worry about the form. So the only thing that is important is that it goes up with our current wealth and it goes down with the square of it. So this is what is known as quadratic utility function. Here, lambda is a particular risk parameter that will vary from different person to one individual to another. It's called it's a risk parameter, and given this function, so we can prove that the expected utility, which we are supposed to maximize, is a function of the mean of our wealth or our portfolio as such, or the variance of that. So it all boils down to mean and variance with some certain assumptions. And then effectively building a portfolio which is optimization of our expected wealth becomes an balance between the mean and the variance of the portfolio. Now, um, as I say, that this is also the modern portfolio theory. Now, you may not like this particular form of the utility function. In fact, it is not a very nice form. There are many theoretical issues with this. But if you don't like it, if you just accept that all asset returns are normal, even in that case, without assuming any form of the utility functions that you're going to optimize, we can come to the same conclusion, because since all the asset returns are normal, their weighted average, the weighted sum rather, which is the portfolio or the wealth, that will also be a normal distribution. And as we know that normal distribution can be totally expressed in terms of its first moment, the mean and the variance. So again, optimization becomes a balance between mean and variance. And this brings us to what is known as modern portfolio theory.
Okay, so Now, how do we build a portfolio based on this modern portfolio theory? Like you just explained what it is, but how can we build a portfolio based on that?
Okay, so let's see that. Before that, what we'll do is that we probably get into some crunching some numbers at this point. So we know what modern portfolio theory is. We know the mathematical backgrounds. We are trying to optimize our expected utility, and we are trying to keep a balance between the mean and the variance. So if we just try to see that how it works in Excel. So this is the optimization. Problem that you're trying to solve. The first one is what you usually see. Second one is usually more easier to understand, but no problem. So we'll have a look at how it works. So what I've done here is just a simple Excel. I have simulated some price for the or some returns from some assets. So this can be some stocks, it can be any assets, it can be strategies, it can be even other portfolios for that matter. So we have assumed some stream of returns. So it's generated by some simulations. So next, what you do is that uh, we compute the covariance matrix. Now, for those of you who are not very familiar with what a covariance matrix is I suggest that you it's not very complicated. It's essentially um, a, a relationship between the variance of two time series. For exact values, you can go to Wikipedia, for example, and check out, or you can use the built-in functions. So for example, in Excel, we have this built-in function for covariance. I'm using the function called covariance.s. S stands for sample covariance. So we're computing this covariance function, and then we are assuming some weights. So let's say this is some weights where we are going to put um, all our investment into the asset one and the rest are zero. So if you do that, then what is our portfolio return? So our portfolio returns becomes effectively this weights multiplied by the returns of this individual asset series. So it's just some product of this weights and this return. So these returns are effectively the I've taken average. This average gives us the function average in Excel gives us the arithmetic means. Technically, I should have taken the geometric mean. So I have cheated a bit, but it's fine for the purpose that we have here. So this is our portfolio return. So we have the weighted average return of the 5 assets. The portfolio variance, on the other hand, is again, it's a weighted uh, weighted value of the covariance matrix. The way we measure is that take uh, we take a transpose versus non-transpose sandwiched and sandwich the covariance matrix in between. It gives us a scalar value. So if you're not familiar with the expression, actually you will see that expression in the presentation that we had. We can have a quick look at it. So this is what you are trying to compute here. W are the weight, sigma is the covariance matrix that we have seen, the capital sigma, and this is the portfolio variance, the small sigma, and mu is the portfolio returns that you have just seen. Now going back to the sheet, so this is what you get. And the portfolio risk is just a square root. So I scaled it. I scaled it with, these are daily returns I've assumed. So I've scaled them with a annualization factor 252, which is the standard annualization factor, assuming 252 working days in a year. And the portfolio returns with that scaling become 11%, and the portfolio risk becomes 21%. Now, if you want to do an optimization problem, so one way of doing it is to vary these assets, these weights, and vary these weights and compute this portfolio return and the portfolio variance for all possible cases that you can think of. So if you do that, this is exactly what you have done there. So we have varied this asset in such a manner so that they always adds up to 1. And then we have computed the returns, and based on the same formula that you used here, and the variance, and from the variance the risk, right? And from the risk and the returns, we've computed the Sharpe ratio. Sharpe ratio, as I explained, is just the ratio of the return versus um, the risk. So if we do that, we get to see a plot like this. So all these dots here are a particular combination of different asset allocation between these 5 assets, and the dot is the portfolio and is plotted in the risk. So risk is along the x-axis and return is along the y-axis, so risk and return space. So if you see that, it gets a curve like this. So for example, if I have a risk preference for this much, so I have a choice of all this portfolio that lies on this particular line, that perpendicular line from this point upwards. But for this particular one, that is at the top of this curved area, so that gives me the maximum return, right? So this particular area is called the efficient frontier. Uh, for those of you who are very familiar, you already figured it out. So this is what we call the efficient frontier in modern portfolio theory. And the theory says that for a given risk tolerance, your portfolio should always be on the efficient frontier, which makes very trivial sense, because otherwise you get a lower returns than what you could have. So yes, of course, we agree. Now, the interesting thing is that this is about if you have only risky assets in your universe. Now, if you add something non-risky asset, that is a risk-free asset, that is the correct term, then it becomes even more interesting. So for example, what I've done is that I've assumed that the risk-free rate is 4%. And the risk for a risk-free asset is, of course, 0. So what I'm going to do is that if I change the axis and go back to starting from 0, so I'm going to plot a line from here to a line starting from 0 to this the topmost point here. So for all the lines from any point on this area joining 0 is the slope of that line is obviously the Sharpe ratio of that line, because it's return versus the risk. So the slope of the line, or you can say the tan theta, the slope of the line, let's say for the simplicity, is the Sharpe ratio. And what you're trying to do is that you're trying to pick out the highest Sharpe ratio, which is from 0 to tangent to this particular efficient frontier. This is called the tangent portfolio, or it is a base Sharpe portfolio. So if you pick up that particular point, let's say this is here, and join a straight line to this 4, so then you can see that if you have an option to invest either in a risk-free or in a risk return, your returns will always be on that straight line. So for example, I have drawn this straight line here. So your return should always be on this straight line, because otherwise at any given point in a any given risk. So for example, even if you're on the efficient frontier, you can still do better by investing a bit more in the risk-free rate. And so this is the line that where you should always invest if you have a choice for risk rate. So that means if the investors are intelligent, all the portfolios for all investors will be somewhere along this line. So somewhere exactly where, that will depend on what's your risk tolerance. If you want 14%, you'll be here. If you want 10%, it will be here. But it will be somewhere in the line. And this line is known as the security market line. Now, we are just drawing it for only 5 stocks, but if you do it for all the stocks in the universe, then this the most efficient point, that is the highest Sharpe point. So that is something called a market portfolio. And then basically it becomes a choice between buying the market portfolio and buying a risk-free asset and defining the allocations. So this is what modern portfolio tells us. And actually, if you're very careful, then you might have noticed that there is a very interesting property. So we just see that what modern portfolio tells us now, that the intelligent investors will always end up between a risk-free rate and a market portfolio. What do we flip it? What do we say that given intelligent investors and market equilibrium, what this means for the market prices? And this leads us to a very interesting thing, which is a very essential tool for portfolio optimization called CAPM, the Capital Asset Pricing Model.
What exactly is this capital asset pricing model? If you could just explain that.
Yeah, sure. So if you see that one of the biggest contribution of MPT, the modern portfolio theory, what I think is it changes what is our concept of risk. So um, usually measure, as I say, that in finance we measure the risk as a standard deviation, but now since we have a choice between the market portfolio and the risk-free rate, then obviously that means for any new asset that comes in, and we have to redraw the entire chart again. What we are looking for is not the standalone standard deviation or the standalone risk of that asset. We are looking for how much that asset is going to contribute in terms of risk to the market portfolio, or as we say, the beta. So the measure of risk, that is a contribution to the market portfolio, becomes a measure of risk for an individual asset and not the standalone risk, standalone standard deviation of that. And that brings us to a CAPM through some mathematical jugglery, which we can skip. And CAPM can be captured in these two equations. The lower equation says that what is a realized return. So the realized return is something called alpha, that is the intercept, and then something called realized risk premium, which is the difference between the risk-free rate and the realized market return multiplied by the actual beta or the realized beta. And then you have some idiosyncratic risk term, which is called uh, epsilon. And if you take the expectation on that as you know that we have to do a mean variance optimization, so you have to measure the variance and you have to estimate the mean as well. So the mean is estimated mean is essentially the expectation of this return. And if you do that, then it becomes, as you know that the market is efficient, so it assumes that you cannot have any alpha, so it basically degenerates into the risk-free rate. And then the other term becomes just the expectation on the return of the markets minus the risk-free rate. Risk-free rate is of course given, so there is no change if you take the expectation multiplied by the beta. So this is what a CAPM model is. It says that the required rate or the theoretical returns of a risky asset is the risk-free rate plus is beta, that is some kind of contribution to the market portfolio in terms of risk, multiplied by the difference in the market rate, market returns minus the risk-free return. So as we've seen that this is what is called a risk premium. So it's basically the risk premium multiplied by the beta, market risk premium multiplied by the beta, that becomes the asset risk premium. So it's essentially risk-free rate plus the asset risk premium. So this gives us a theoretical basis for what you call the value investing. So value investing is basically, essentially is looking at the CAPM model or any other equivalent model and seeing that what the value can be, and then see that whether the actual traded value is very far off from there, and based on that you either buy or sell the asset. Now how you use the CAPM model, that is that varies a lot. So for example, you can use a discounted cash flow model, or you can use a comparison model, so any other model. So essentially you use the CAPM through those models to estimate the fair price, and then you figure out the opportunity. So this is what the value investing is. So you are trying to say that I'm trying to, although the market says that I'm going to get risk premium, risk rate and the risk premium, but I'm going to capitalize on my better understanding into the alpha that you see in the realized part. So this is what the value investing is. You bet on the idiosyncratic upside and hedge the market risk.
So, as you said, CAPM inspires value investing. So, are we saying that this is how we should build our portfolio, or what?
That's very interesting. So let's see. So is it really that? Um, do we really think that the idiosyncratic risk is idiosyncratic? So if you agree to this question that it is really idiosyncratic, then that's it. So you should go for value investing, and that's pretty much what you can do. But if you think that the CAPM doesn't do a great job, we can do better. That is where the factor investing comes in. So it was pioneered in 70s. It was popular. It became very popular after 2008 because of the correlation one event where everything crashed simultaneously, and there was there's no benefit of diversification, the so-called diversification. So what factor model says that hold on, it's not just the risk-free rate plus your beta into the market risk premium. It's risk-free rate plus a series of risk premium, and market is just one of the factor. So the expectation equation become very familiar to the one we have just seen, but instead of just a single risk premium multiplied by beta, we have a series k different factors which are summed up to arrive at the expected return. And similarly, the realized equation also just mirrors the same thing. And the way we started on this is something called APT, the arbitrage pricing theorem. So that provided us a framework without specifying all these factors. So the risk premiums are the change in the factor. So without specifying what are these factors are, it gives us a framework to actually analyze this kind of expression. And then this famous paper from Farmer and French, they came up with three factors. That is, one factor is the market, and in addition, another two. And that changed. That was one of the pioneering paper in this domain, and that changed a lot. And then there was then there was some other pioneering papers on the factor investing, especially from Jagdish Tetler on the momentum investing, and later on, very recently, Pedersen and others on the time series momentum investing, and a lot of other factors. So now factor investing is pretty much established way of investing, and that says that idiosyncratic risk is not idiosyncratic. You can explain it further using different factors, and that gives us our new interpretation of what you call alpha and beta. So alpha and beta, as you see in the CAPM model, just the intercept and just the coefficient. Now we say that alpha and beta is not that. What if the delta F in the equation is time invariant and positive along with beta? So that means that your first equation, the realized return, your second term becomes a constant. So that piles up with your first term, the alpha. So together they becomes the total alpha, and this is the purest alpha you can get as an investor, where your risk factors are totally deterministic, your beta is also totally deterministic and even constant. So that is pure alpha. What if your risk premium is stable but beta varies? So this is where you know that you have a risk premium somewhere, but you don't know how much you're trying to get. It depends on the particular situation of the economy or the business cycle or whatever. So that leads us to a style of investing, a portfolio optimization called the factor allocation. So that is where you try to allocate differently among different factors and try to rebalance it from time to time. And if beta is stable and the risk premium varies, then the strategy that we are going to follow is what you call the factor timing, where we know exactly that what is the our sensitivity to a particular factor is, but we don't know what will be the change in the factor. So we are trying to predict that change by whatever means, a better model or technical analysis or quantitative analysis. So we are best trying to predict the factor change and build a portfolio. So that is factor timing. And what if everything unpredictable? Then your best bet is just the alpha the first term, and you go back to value investing, stock picking. So that means it is really idiosyncratic. The factors doesn't make sense for this particular asset.
Okay, so let's just assume I'm a retail trader. Which one do you think makes more sense for me? Value investing or factor investing?
Well, the issue with the value investing is that if you really go for the pure play value investing, you see that you're basically relying on the idiosyncratic part, and that necessarily means that you have to have very good research on this company. So that necessarily means that you are going to go for concentration and upside of idiosyncratic risk. Now, that is fine for if you're a particular type of investors like Warren Buffett, but if you're a retail investor, it may not be suitable for you. Although we get lulled into the belief that anybody can do value investors, but we really don't have that sort of management access or that sort of scale in capital that big value investors have. And that makes a lot of difference. So in the CAPM world, the job of an investor, if you believe in CAPM, the job of an investor is to find the assets with the highest expected residual return. Why residual? Because you don't get paid for the systematic risk. The systematic risk should be diversified away. If you believe in factor model, that those all the idiosyncratic risk predicted by the CAPM is not really idiosyncratic, can be explained further, then the paradigm of your investing become very different. Here, you are not focused on idiosyncratic risk, but you're focused on the overall market driver. So you are systematically probing the market driver, coming up with new or better or improved factors, and then you are allocating based on the factors, as you have seen, whether pure alpha or factor timing or factor allocation, whatever. So there, instead of doing in-depth research on a few companies, you are doing a broad research on the nature of the market or the economy as a whole. So it is a very, very different ballgame, right? It looks same, but fundamentally it is different.
Okay. And so, what would you say would be the basic difference then between discretionary and quantitative research, and when we should prefer one over the other?
Value investing and quantitative trading, like a factor research, is it's not that one or other. Is both of them has value. So let's see quickly. So for example, um, here is a question for you guys. So let's assume that you have two asset managers. One is A and one is B. A is value investors or discretionary investors doing stock research and all. So he can only do some 10 different stocks with enough diligence, whereas asset manager B is a systematic manager and she can look after a huge number of stocks through his powerful computers, 500. So the question is that what should be the skill level of A to achieve an outperformance of at least 50% of your portfolio? So he manages only 10 stocks, so 50% means 5 stocks. So you have to outperform 50% with a certain given confidence level, so 95% confidence. And what should be the same for B? What should be her skill level? So um, if you solve this problem in a very simplistic way, so this can be solved using what is known as binomial probability distribution. So if you see that the investing skill that you require for both the scenarios is starkly different. For B, we achieve the outperformance target at a slightly level slightly higher than 50%, around 55 and 57%. You achieve the target. But for B, for A, it has to be a very high level of skill. So it has to go way above 70%. And 70% here means that whatever you predict, which stocks will go up or go down, you have to be correct 70% of the time. And this is not a very easy thing to do. So this says that what can be the upside of uh, quantitative management. Now, this is of course not all, because the main difference between, so of course that will just means that don't do value investing, just do quant, but that is not the case. So value investing also has its own age, which is superior insight, vis-a-vis the superior information processing age of the quant investors. So the game here is that as a value investors, although your probability of success is low, you can hit on one of those multi-baggers. But as a quant strategist, your probability of success is very high, but you are probably going to generate um, relatively lower but much more steadier stream of returns. So in a portfolio, ideally, you'd like to have both sorts of things, but this is the main difference, and this comes from something called the fundamental law of investment. In case you guys are not aware, so this looks like this. The expression below, IR is the information ratio. This basically says that how much you have outperformed your benchmark, normalized by the risk of your portfolio, and that equates to something called IC. IC is the information coefficient, which is very similar to what you have seen before as the skill level, the hit ratio, multiplied by the square root of n. And n is the main differentiating factor here. N is the number of independent bets that you can take. So for B, it was 500. For A, it was only 10. And as you see that it goes with the proportionally with the square root of n. So for B, it adds a lots of age to this information ratio. And TC is something called transfer coefficient, which is not very important here. So as you see that the basic difference is the n, and as a quant investors, since we can have a higher number of n because of our different our way of looking at many different stocks simultaneously, that's why we have the h. So if you really want to optimize a factor portfolio, so first thing is that you have to research those factors, figure out those factors. There are multiple ways of finding factors. This is not the webinar for a talk about how to find and how to develop factors. But once you have done it, then it's a very similar optimization problem again. So you'll see that we had a expression very similar before. The first term here in the first line, what we are trying to maximize. The first term is return multiplied by the weights, and that is basically the rewards that you're getting. And the second line is the variance, which is the risk that the cost of return, the cost of rewards. And in the cost of rewards, you'll see that we just had a sigma before. Now we have an expanded expression there. And that is because we have a source of covariance matrix from the factors. And also whatever is not explained by the factors, that is the residuals. And we have a variance matrix from those residuals as well. So, and necessarily we have a different lambda as well for that, the sensitivity to each of these factors that you want to optimize. So one is the factor lambda, one is the asset lambda. So again, we can just normalize, optimize this expression and come up with the factor allocation. So it's not very significantly different.
So, do you think are there any other optimization methods that, apart from mean variance, that can be used?
So mean variance is a very, very useful method for developing a portfolio. So even if your underlying assumptions are not correct, they're more often than not closer to the perfect solution. So we should never underestimate mean variance optimization. At the same time, as I've seen before, that average portfolio is also not something to be underestimated. Because if you are very, very skeptical about our models, that is what we should do. But there are other situations as well where you can do something different. So for example, Kelly optimizations or risk parity optimizations. So if you talk about the Kelly, so the expression that you're trying to use for the utility function is slightly different. So it's a log expression. ln stands for logarithm to natural base. So it looks complicated, but it's really not. What it's trying to do is that it's trying to optimize or maximize your terminal wealth. So for a multi-period, for each period, you are accumulating wealth, 1 plus R1 into 1 plus R2 into 1 plus R3 and so on. So then you're you're trying to maximize this. So instead of maximizing this complicated expression, you're taking log so that it becomes easier. So it kind of become a log utility function. And then you're trying to also maximize this expression. So it's mathematically great. In fact, it comes under the family of things that we call constant relative risk aversion. We're not going to get into that. In case you're interested, you can ask me later. So what about the practicality it is? So we see that from both theoretically and from practice, we see that the Kelly portfolio in the long run, it dominates all other strategies in terms of the final wealth, because of course it's focused on maximizing final wealth, and also the time achieved to that. So fastest and the highest, which sounds very good, but of course, if you're familiar with finance, you know that there's no free lunch. So it comes at a cost. The cost is that it is most aggressive in terms of risk. So the risk parameter, the risk averseness is most aggressive. That is the lowest. So among similar class of utility models. So here, what you do is that you run a higher risk of ruin in the short run, in the short term, with the promise of being the best in the long run. So it is basically, so if you think about it, if you are very young and just started investing, and you can you can take a hit essentially. So Kelly is not a very bad thing for you, but are you going to suggest Kelly for a retiree? Probably no. That will be probably not what she needs. There are other optimization things like the risk parity that we have talked about. So risk parity is a very different beast. So here we are talking about equating what you call the individual risk contribution. So the expression is above. It's something like you are taking the sensitivity of the risk with respect to a particular asset I, the derivatives part of it, and then we are just weighing with the particular asset allocation in that asset I, and we're saying that this is my individual risk contribution. If you see that all this sums up to the portfolio risk, it can be proven mathematically, so you can just take my word for it. And what you're demanding is that the sigma I, for all assets, should be equal. So this is risk parity. There is no theoretical justification here. So it's just something that people thought it makes sense that all your stuff in your portfolio will have equal risk. Now, if you think about it, the most important part is that it talks only about risk. So whether in MPT or whether in Kelly or whether in any other things that I've seen, it's a basically balance between mean and variance. Means is essentially your returns and variance is the risk. Here we are only talking about risk, no returns, right? So if the market is efficient, of course the risk should be proportional to the returns, but here we do not talk about explicitly about that. So what the upside of that? The upside is that we are far more we have far more better model to measure risk than returns. So this kind of allocations become far superior in terms of its robustness to model errors, right?
So yeah, as I can see, so what do you say, when to use what? When do we use Kelly, risk parity versus mean variance optimization? How do we know when to use what?
Okay, so if you're very sure about the models, then the mean variance and the Kelly are good candidates. So here you are trying to make a balance between the risk and the returns. Kelly is probably, as we've seen, that is good for someone who can take a hit for the upside of long-term superiority. And mean variance is a bit more moderate. So any of this, depending on your risk appetite, can be a good choice for you. On the other hand, um, also doing this, Kelly or your mean variance optimization. If you're using CAPM, that is a certain level of modeling. So you have to model your returns as well as risk. Risk you can measure, model something that you have to model, return something that you have to model. So if you're using CAPM, as you have seen that modeling through factors probably improve your modeling. Why? Because you're even splitting, you're explaining the idiosyncratic returns. Whatever CAPM says that this is random, you're saying that no, it's not random. So you obviously your modeling accuracy goes up. So if you're using either Kelly or mean variance, the MPT, probably you want to do a factor based modeling for your expected return. But if your model is not good, then you can essentially go for risk parity. Why? Because I've seen that the risk parity is not very sensitive for the returns model. And that leaves us, as I say, that leaves us to a very robust thing. But I'm not very confident about risk parity. So nobody knows. Means, of course, means people are using it. It's been very successful, but it's not very clear that, as I said, that there's no fundamental theoretical background, and it can just be a lucky run for the risk parity guys. But yes, it is. It works, at least um, backward-lookingly. And as I said, as we've seen before, that if you don't trust anything, then we go for an equal weighted portfolio.
Well, that sounds great. And I just have few more questions. Like, I just have two more questions to ask you. What about alpha strategies? I mean, how can we combine them to create a good portfolio for ourselves?
So we can use all this optimization technique for alpha strategies as well. So these techniques are quite general in the terms that they just assume. So when they talk about asset, they're just talking about a stream of returns and nothing else, nothing more. So we can use this, but there are some issues, of course. Means, for example, if you think about it, if you're using mean variance optimization for a portfolio with alpha strategies, then as these are alpha strategies, so they are totally uncorrelated. So if you pick up some uncorrelated assets and try to run a mean variance, you'll see that all the allocation goes to a strategy that is the best strategy. And of course, as I said, that best strategy is just backward looking. It's just based historically. So you'll end up with all your allocation in a single strategy. So it is not really a portfolio as such, right? And that's why sometimes we follow some other criteria. So so what are the other criteria? So for example, you want to come up with some sort of assurance that you pick more than one strategist in a systematic way, and in such a manner so that it takes into account the feedbacks. So one of them is the ensemble strategy. The ensemble strategy, so the average portfolio is actually can be even think of as an ensemble strategy where all the strategies has equal vote and the voting weights doesn't change over time. So that leads us to an average strategy. Then the regime switching portfolio that use some sort of change analysis, you can use a hidden Markov model, you can use a change point analysis, so many different ways that essentially tries to see that for all your different strategies, alpha strategies, the parameters, are there is shift in the parameters, and if there, then whether I need to reallocate the capital between them. And similarly, there are other online learning techniques as well. So no regret is one of them, where we try to be adaptive about our weighing based on the most recent performance. Usually we do it based on the maximizing the returns, where we can do it on the Sharpe ratio or just the risk measures. And that's it. That's pretty much it. So for example, to do this on so if we pick up the last one, so no regrets. So what it is. So we mostly understand the others. We have some ideas about the others, but if you specifically look into the no regrets, so it's basically playing multiple slot machines as one. So think about your alpha strategies as each of this one of these slot machines. So sometimes they work, sometimes they don't. Now you have two choices. So if you go to a casino and play 4 slot machines, so your choice is that you have to have a faith that they have some edge, right? Next, if you don't have any faith, then you can just pick one, or you'll not even may not play at all, right? But if you have a faith that they have some edge, then your objective is to explore each one of them and figure out which one has that edge. And once you figure out which one, then go heavily on that one, right? So this is a typical problem called multi-arm bandit model. So this is a exploration versus exploitation problem. And no regret is a very succinct way of solving this problem by doing some sort of exponential weighing. So the weight that we see here is the same thing that I've seen before, the capital allocation. And we use a rate called eta here, the letter that looks like n. So this is called a learning rate, which we change, using which we change the weights based on the most recent performance. And this makes us a balance between the exploitation and the exploration. So this is pretty much what no regret. So of course, it's kind of a follow the leader strategy. So we are doing the multiplicative updates, and of course, in a sideways market, it will not work. So these are many different ways of doing your portfolio optimization and build a portfolio. So for more, you can look at, you can go to, of course, you can pick up these topics from this presentation and go to Wikipedia. There are many, lots of free material available as well. Or you can go to, so for example, we also have a course on, which is a recently launched course on quantitative portfolio management. And you can also have a look at it at the course structure. And it talks about a few of these things. Uh, and talks about them in more detail than what I could cover. I think that's it. We have. Do you have anything else? So I will hand over the mic to Garima, and I thank all of you for your patience.
I would just like to talk a little bit about our few initiatives that QuantInsti has and which might be useful for a lot of you guys. Our flagship course, Executive Program in Algorithmic Trading, is the world's first verified certification offered to professionals looking to enter or grow in the algorithmic and quantitative trading industry, and also in which we have a detailed modules on portfolio management. We also launched an interactive self-paced learning portal, Quantra, offering 20 plus courses, including quantitative portfolio management, which, as Pradipta mentioned, explains all the concepts in depth. With the vision of becoming a global knowledge and technology powerhouse in this domain, we also launched Quantra Blue Shift that Pradipta has also mentioned while he was explaining certain terms, which is in its alpha stage and allows you to convert your ideas into strategies and backtest them for free. Now, I would just like to thank Pradipta for his taking out time and for this very exciting interview, and want to thank all of you for participating and being very patient. So, have a great day, everyone, and thank you so much for joining in. For any other information, you can always log into our website. You can go to our learning portal, Quantra, or as Pradipta mentioned, you can, for your backtesting strategies, you can always log into Quantra Blue Shift. Thank you so much for joining in. Have a great day, great night. Bye bye.